Thanks for clicking. Canadian governments are leaving the dirty work of slowing down Canada's inflation rate to the Bank of Canada, while they themselves continue to spend. This according to a new report coming from CIBC. And this isn't the first time that government spending has been accused of being at odds with the Bank of Canada's efforts, with even Governor Macklem just last year, noting that had the government limited its pandemic stimulus, the bank's job would have been much easier. And the report comes as the Bank of Canada surprised many in the market last week when it announced it was ending its interest rate pause and raised rates by 25 basis points, with many predicting that more rate hikes are on the way. And, says the report from CIBC, continual government spending is fueling the inflation fire, which could delay rate cuts coming until June of 2024. With that said, as we've gone over so many times on this channel, as with anything, it's important to question the source. So what I want to do today is go over the report from CIBC, taking a look at how it says government spending is fueling the inflation fire, and then discuss some potential reasons why CIBC might be a little overly concerned with grocery rebates. The CRA is set to release Canada's national sales data for the month of May on Thursday, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into CIBC's report. Onto the report. CIBC begins the report by arguing that although there are many tools available to slow down an economy, Canada has relied almost solely on interest rate hikes and the Bank of Canada to do its dirty work.
I get no appreciation for.
And if this continues, says CIBC, if slowing down the economy is left almost solely to the Bank of Canada, then we won't be seeing our first interest rate cut until June of 2024. And even then, by the end of 2024, rates will still have to be well above 2.5%. And all of this is because the government has been active in pushing up GDP, employment, and wages, all of which the Bank of Canada has been fairly clear it wants to actively reduce. According to the CIBC report, direct government spending is still adding a couple of ticks to overall GDP growth. And the report says that this stands in stark contrast to the post-2008 recovery, when, by 2010, government spending was actually subtracting from GDP growth, allowing Canada to keep interest rates lower for the next few years. The report points to recent direct spending programs, such as the grocery rebate, which it says, if spent right away, will add about 0.4% to Canada's GDP annualized.
Do you realize what you've done?
But it's not just the growth in government spending that is putting upward pressure on inflation. It's also government job growth. Government job growth has far outpaced that of private sector growth over the past few years. And the report notes that had public sector job growth just kept pace with that of the private sector, not even been less, but just kept pace, then we would have seen Canada's unemployment rate rise by over 1%. And had the Bank of Canada seen this uptick in unemployment, this would have obviated the need for further interest rate hikes. And yeah, this makes sense. The Bank of Canada has been adamant that it wants to see job loss before it can start to cut interest rates. It wants to see a cooling labor market. And if government job growth is propping up the employment market, then this is indeed hampering the Bank of Canada's efforts. And finally, wages. While the Bank of Canada has been adamant that employers not increase wages, doing so could contribute to inflation, the CIBC report notes that recent wage increases granted by the federal government could set a precedent for wage negotiations at other levels of government. And, as such, taken together, given the increase in direct government spending, the increase in public sector hiring, and the increase in wages, CIBC says that the government is missing an opportunity to get inflation back down to that 2% target rate in short order. However, with all of that said, as with anything, I think it's important that we consider the source. As we talked about a few months ago in March of this year, 1/5 of CIBC mortgage borrowers are negatively amortizing their loans, meaning their loan balances are actually increasing. Their borrowers aren't making their minimum payments, and the difference is being tacked on to their principal. So, 1/5 of CIBC mortgage borrowers aren't making their minimum payments. We haven't seen a massive amount of defaults on CIBC's books, as CIBC is continuing to hold the mortgages and not registering these as being in default, but nonetheless, this isn't good for CIBC's mortgage book of business. And with interest rates going back up and set to continue to go up further, it's not likely that this is going to be getting any better anytime soon. And CIBC alludes to this in its report, sort of, noting that mortgage renewals for Canadians in 2024 and 2025 could be significant risk to household financial stability if the Bank of Canada hasn't sufficiently eased policy by then. So, says the report, if the Bank of Canada hasn't been able to reverse course by 2024 to 2025, this could cause a real problem for those mortgages that are coming up for renewal.
I want you to understand that I am looking out for you in this thing, okay?
The report goes on. A somewhat tighter fiscal path would give the central bank more elbow room to start that process. So, what CIBC is saying is that if the government spent less money, if they took a tighter fiscal path, then that would leave more room for the Bank of Canada to lower rates, which would make it easier on those borrowers who have renewals coming up in 2024 and 2025. It would make it easier on those borrowers to make their payments to CIBC, and other banks as well, but definitely also CIBC. And I don't think CIBC is wrong. Government spending, especially deficit spending, is almost by definition inflationary. With that said, with 1/5 of its loans negatively amortizing, with 1/5 of its customers not making their payments, CIBC definitely has a vested interest in the Bank of Canada lowering interest rates in time for those renewals. With all of that said, it is somewhat surprising to see a bank have the gall to come out publicly and say that the grocery rebate should be held back so that mortgage payments can be made when renewals come up in 2024 and 2025. While CIBC is saying that government spending is limiting the Bank of Canada's ability to get inflation back down to that 2% level, what this really comes down to is who is going to pay for the pandemic. Is it going to be the average worker who is seeing their buying power severely diminished as a result of the inflation caused by pandemic spending? Or is it going to be those who are most negatively impacted by the rise in the cost of borrowing? The banks, the homeowners that purchased at pandemic highs. That all remains to be seen. With that said, we will continue to track the Bank of Canada as well as Canada's inflation rate on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.